Hey there, Vinny from Project Frugal. Today we're going to be having a look at this. You can either save it, you can spend it, or you can invest it. What are you going to do? Check it out. And here we go. It's the humble 100 New Zealand dollar bill. Now $100 is not worth what it used to be, but it's still $100. We're going to see what we can do with this $100, see if we can actually make some money out of it, or maybe not. Let's find out. In the first scenario, we're going out for dinner. We're going to spend the entire $100 on a lovely meal for two. Denise will be happy, but unfortunately, after a couple of hours, the money's all gone, and what are we left with? Just a full stomach. In scenario 2, all we're going to do is squirrel the money away, put it under the mattress, saving it for a rainy day, and it just so happens it's raining outside. Now the problem with putting it under the mattress in the first place is you're actually going to lose money. Inflation is going to eat that money, and slowly but surely, let's say inflation is 3% a year, it's going to be worth $97 worth of purchasing power next year. Yeah, and it goes down from there. And the last scenario is we're going to invest it and we're going to make some assumptions. So let's go and check that out. We've come on to calculator.net, link will be down in the description below. This is the investment calculator. We're going to simply put in $100 in here. We're going to go after 10 years. We're going to assume an average return of 7%. Let's chuck that number in there. There'll be no additional money going into this. We're going to be investing, so-called investing this money into the New Zealand stock market. We're going to assume that we're going to get a 7% return after tax. Yeah, after inflation. We're going for rough numbers here. We're not going to be exact. Let's see what this will do. Let's click on calculate. We're adding no additional money. $100, 10 years, 7%. Here we go. And as you can see, our $100 has magically turned into $196.72. So it's pretty much doubled its value after 10 years. Now sure, $196.72 is not going to have the same buying power that $100 is today, or is that the right way around? Well, I'm not quite sure on that, but you get what I mean, right? So $196 in 10 years time is not $196 if you know what I mean. However, what we can find here is we've put our $100 in, we've done nothing more, and slowly over time we've increased interest. You can see here our initial $100. The first year we get $7, we're making it as simple as possible. The following year we're doing nothing, we get another $7.49, compounding interest here. We're up to $114.49, that's going to compound again. Now we're getting $8.01 and so on and so forth up to this point here after year 10, $196.72. Now what about if you put $100 a week into this for 10 years? How much money would you have then? Just $100. So in this example we're saying we're starting off with $100, we're still going with the 7% return rate, compounding annually. Additional contribution will be $100. Now it doesn't allow for weekly contributions in here, so yeah, we'll go for $433.33. That is basically $5,200 a year divided by 12, $433.33, the equivalent of $100 a week. We're putting that money in at the end of each month, and we're going to compound the whole lot. How much are we going to have? Well, let's wait and see. Here we go, drum roll please. And ooh, look at that, $74,000. Not too bad at all. $74,000, $100 a week. 10 years, it's a long time. How much have we put in? Well, it's pretty much $52,000. We've made $22,000 in interest, and at that point, once we've reached that point, we can see here we've got a monthly schedule as well. Let's click on that. Scrolling down through all the years, essentially, if we did that for 10 years, we would be making $415.41 every month, and at that point, it's for the rest of your life. You're going to get $415.41. You could allow that to continue compounding. It's literally $100 a week. We could just keep the cycle going at that point and just, yeah, build up some more money. Now, of course, you don't have to put in $100 a week for 10 years. Let's up the stakes, eh? Let's go and see what would happen if we doubled our money, put in $200 a week. It's probably going to be a lot more. We've got $74,000 here. Let's just go $200 here. Starting amount $200. Let's double this to $866.66 and let's calculate. And lo and behold, $148,637.12. Now let's go extreme. $500 a week. That's how much we've been putting into Denise's portfolio. Ooh, let's just say $2,000 a month, right? Chuck in $500, $2,000 a month, 10 years, 7% interest, calculate. Well, now we're getting somewhere, $343,000. If we got up to that amount, we'd be earning $21,585.69 every, well, that's in a year. That's in a year. If we change the monthly schedule, we can scroll right down to the bottom. We're getting almost $2,000 a month. Yeah, it's a long time to save, no doubt about it. $500 a week for 10 years. However, if you're making $2,000 a month after 10 years, would it be worth it? Would it be worth that sacrifice for putting in $500? Ooh, it's up to you. Yeah, we changed things up. Maybe we got to the end of that. Maybe we did this for 10 years and just saved the money. Let's chuck that in here. Let's chuck in $343,000 and we're going to put no more money in at the end of that. We're going to call this 20 years. So we've saved hard for the first 10 years. We've saved up $343,000. Now we're going to pretty much do nothing. We're just going to let this compound. $343,000, putting no additional money in. Let's calculate and see where we end up. So this is for 20 years. Ooh, $674,000. We've basically doubled our money. We've only saved it for 10 years. It's still a long time. Chucking in $500 a week. It's a long time. It's a lot of weeks to put $500 in. And then for the following 10 years, pretty much doing nothing. We've doubled our money after the following 10 years and just let the magic of compound interest do its thing. And there we have it. You could literally grab this $100. You could spend it on stuff that'll last a couple of hours. You can chuck it under your mattress where it'll lose 3% every year due to inflation, maybe more. Current market, you'll be losing more than that. Or you could invest it, chuck it in a term deposit, even if it's just a term deposit earning, let's say 6% or 5.5% before tax. Yeah, okay, it's not that great. Chuck it in the stock market, something that's a bit more risky, but it's going to give you a higher return. In this case, we're saying 7%. And yeah, let the magic of compounding do its thing. And the beauty is, if you got more than one of these, keep going, keep doing it, and you'll get somewhere, no doubt about it. Thanks for sticking around. Don't forget to like and subscribe, and we'll catch you later. See ya.